the commissioner, to the commissioner, to transfer, transfer taxable goods to the subjected taxable goods without charging VAT, without charging VAT. Then say that for this to happen, the following, we say that the following details needs to be provided. The two registered person, we say that a business is transferred by a registered person as a going concern to another registered person. Both of them can basically agree to apply for VAT, to apply for to supply the goods without charging VAT. But you're saying that a number of details needs to be basically submitted when that is applied for, that taxable goods without charging VAT. So one of the details that is required is details of the transaction. That needs to be details of what we call the transaction. Detail of the transaction. One is the detail of the transaction. We have detail of arrangement made. Details of what we call the arrangement made. Details of the arrangement made for payment of tax due, for payment of the tax due, for payment of what we call the tax due on suppliers already made. We have number 3 as a detail that is required. We know that description of transaction. Description of the transaction. Description of the transaction as also a detail that is required. But we also have quantity and values of taxable goods. Quantities and what we call and values on hand, and at the date, and at the date of what we call disposal, and at the date of disposal. The details of quantities and values of taxable goods on hand, and at the date of disposal, that needs to be provided. And we're saying basically that unless Commission has reason to believe that there would be undue risk on revenue, and notify registered person within 14 days. Unless otherwise, notify if there will be undue risk on revenue, notify registered person accordingly within 14 days on receipt of the notification. And that's what you're saying, unless otherwise. So we need to note and say that the stock of taxable goods on hand, the stock of the taxable goods on hand can be transferred. The stock of the taxable goods on hand can be transferred without payment of tax. Without payment of tax. Otherwise due or payable. So we're saying these are some of the information that needs the business being disposed by a registered person as a going concern shall remain registered, and all matters of VAT. Otherwise, that business that is being transferred by the person that we know is registered shall remain as a going concern, meaning saying going into unforeseeable future, unless otherwise, and all matters under VAT Act relation to business prior to the disposal will be properly compiled. All issues that pertain to the VAT in the past and the future will basically be compiled. And you're saying that notwithstanding, we're basically saying that further, notwithstanding, that the business, we say that the business is notwithstanding that the business is of the registered person, of what you call the registered person, notwithstanding that the business of the registered person as a going concern, then you say that going concern that registered shall remain, that the person that is registered shall remain registered, we say shall remain registered, and be responsible, shall remain for all matters, we say related to VAT, that shall remain responsible for all matters under VAT, related to VAT Act, related to the VAT Act, in relation to the business, in relation to the business before, or we say related to the business before stroke prior to its disposal. The registered person shall remain shall act on issues pertaining to VAT prior to the disposal, up to the time of what you call disposal, up to the time that you call disposal. Then when we do away with the asset, that is the time, until such time that before the disposal, when you say until such time as the requirements of what you call the acts, until such time the requirements of the acts have been properly compiled. So a registered person, before the transfer, he remains liable to any issues pertaining to VAT. And you're basically saying that, the moment that he stops being liable is when all requirements as per the Act of the VAT are basically complied with. But you're saying that one of the tax avenue that is available for taxpayers in relation to disposal is that application of transfer of an asset as a going concern without charging VAT, which you say that the number of issues that will be required. One, we talked about details of the transaction in order for that to be applied, details of arrangement meant to be made for payment of tax due or supplies already made, descriptions of the transaction. We say that quantity and values of taxable goods on hand at the date of disposal. So we're saying that the stocks of taxable goods on hand, can be transferred without charging VAT, otherwise due or payable. But an explanation into what you're saying, we're basically saying that further, notwithstanding the business, registered person as a going concern, that registered person shall be responsible on matters really pertaining to VAT before the disposal in relation to the business. But it's saying that prior to disposal or up to the time of disposal, until requirements, all that is required in relation to VAT are properly complied with, or as complied with, they become compliant to the requirements of the VAT. So the second area under disposal is stamp duty. We say stamp duty. That is number 2. What we call stamp duty. Stamp duty. What we call stamp duty incentives. Stamp duty incentives. So whenever we talk about stamp duty, we say that this is basically charged on transfer of property. Property is charged on certain documents and transaction. So that is under section, that is to be precise, under section 95. Section 95 of what we call of the Stamp Duty Act. Of the Stamp Duty Act. Incentive stamp duty, section 95 of the Stamp Duty Act. So that section basically provide exemption on stamp duty. This section basically provide exemptions, and when you talk about exemption is you do not pay on stamp duty and reduction on stamp duty on increase of capital. That this section basically provide for exemption of stamp duty on increase, on reduction of increase or reduction of stamp duty, on increase on capital. This section provide exemption or what we call reduction of what we call stamp duty on increase in capital. On increase in capital. So I've said that stamp duty is a tax that is charged under miscellaneous levy, is charged on transfer of property, and is also basically charged on asset. When you talk about incentives, those are waivers that are there. But you're saying that under section 95, that section basically provide exemption or reduction of stamp duty on increase on capital. We know that stamp duty, when a capital value increases, then the stamp duty needs to raise, but there is an exemption that is provided. So in order for company, we say that in order for a company to qualify, for the exemption or reduction, in order for company to qualify for incentives, for incentives, we say, comma, the following conditions must be met. Emphasis. I've said stamp duty is a levy under miscellaneous taxes that is charged on transfer of property, and property basically in question, that those should be land and building. But again, we also need to understand that stamp duty is also charged on certain transaction. But on section 95, we're basically saying that there is in increase, exemption is you're not charged or a reduction of stamp duty on increase on capital that is expected to increase the stamp duty. So one of the conditions that must be met in our quest to get the reduction or the exemption is that there must be a company. There must be a company. Say a company incorporated. There must be company incorporated. There must be a new company in share capital on an existing company. So condition 1, that there must be a new company incorporated in Kenya or an increase in capital on an existing company. That should be it. An increase in share in capital, an increase in share capital of an existing company. So that is the first condition. So one of the things that we were saying, that for that to happen, one of the conditions, there must be a new company incorporated in Kenya or increase in share capital of an existing company. So the company must be incorporated. The keyword is that the company must be basically incorporated, basically to qualify for the incentives. The second, we are basically saying for that condition, for the exemption or reduction of stamp duty, the absorbing company, the absorbing company, is either registered, is either registered or increase in capital, is either registered or increase in capital of existing company. Increase of capital of an existing company, or increase in capital with a view of acquiring, or increase in capital with a view, let's just say with a view of acquiring, and we're very precise, we say acquire 90% with a view of acquiring what you call 90% of the share capital of the share capital of what you call the target company. So the absorbing company is either registered or increased capital with a view of basically acquiring 90% of the target company. That is restructuring. We basically talked about doing away with business, or maybe merging or acquiring another business. So then we say that the consideration of transfer, we say that the consideration of the transfer, the consideration of what you call the transfer, consists of more than, consists of more than 90%. It should basically consist of what you call more than 90%. We say more than 90% of shares issued, of the shares issued that we say are issued in the transferee company, in the transferee's company, in the transferee's company. Then we talk about section 96. Section 96, we have talked about section 95. Exempt from tax instrument, exempt from what you call from tax instruments. To exempt means that not being charged from tax instrument in respect to which in respect to which, we said in respect to which, we're basically in respect to which it is shown to satisfy, to which it is shown to satisfy collector, in which it is shown to satisfy collectors. What are those areas that we have? We say the effect of, therefore, convey or transfer beneficial interest. Effect of transfer of what you call beneficial interest. Effect of transferring of beneficial interest in property. Say from one person to another. From one person to another, beneficial interest in relation to property from one person to another. From one person to another, that is from one precisely company, but from one company to another limited, because the artificial person to another limited company. Remember, in tax we have two types of persons. We have the natural person, who is an individual. We have an artificial person, which is a company. But it's saying effect of transfer of beneficial interest in property from one company to another, limited company. That is one of the area. That either, what should happen? Either, we say either. We're saying that either from one limited company to another, either one of such company, one of such company is beneficial owner, of more than what more than, we say beneficial or more than, or not less than, the percentage you say not less than 90%, not less than 90%. That is under section 6. For that to happen, not less than 90% of the issued company, of what you call the issued share capital, meaning controlling an interest in the company of 90%, not less than 90% and above, 90% and above. And last we say not less than 90%, not less than what you call 90%, not less than 90% percent of issued share capital, not less than 90% of the issued share capital of each of the company, of issued capital of the companies. We bring the third aspect, is not in a third company, is not in a third party company, is not in a third party company, is issued by each of the company, is in a beneficial ownership of the issued companies, is in a beneficial ownership of what you call a third party. Just say of each company is in beneficial ownership of the third company, is in beneficial ownership of the third company, with limited liability, with what you call with limited liability. When you talk about limited liability, they're liable to a certain extent. They're not fully liable for all the issues. They're limited to a certain extent. Then lastly, we can say that the instrument was not executed. That the instrument was not, say, executed. We base that the instrument was not executed in pursuance, in connection. We just say that the instrument was not basically executed in connection with arrangement with arrangement under the following. So we can talk that the instrument was not executed in connection with arrangement under. We say number one, consideration of conveyance. One is consideration of what we call transfer. We say consideration of transfer. Transfer is just basically to pass. Consideration of transfer was to be provided. Transfer was to be provided. Was basically to be provided. Consideration of transfer was basically to be provided, or directly or indirectly. Directly, or what you call indirectly, was basically to be provided directly or indirectly by a person, by a person or individual other than company, other than the company, was that the consideration for transfer was to be provided, was to be effected directly or indirectly by a person and not the company. We say that a company is an artificial person, then an individual is basically a natural person. So you're saying that that consideration of transfer is basically done or provided directly or indirectly by a person other than the company, which is at the time of execution, which is at the time of what you call execution, which is at the time of execution, which is called effecting execution of the instrument. We say was, and lastly we say was either associated with transferor or what you call transferee. We say that's associated with the transferor or by transferee, or was either associated with transferor or transferee. That basically marks the end of what we call disposal of business and restructuring activity. And we talked about tax incentives that are available. On the first part, we basically talked about being able to transfer without charging VAT. The second, we talked about stamp duty incentives, where we say that Section 6095 of the Stamp Duty Act provide for exemption or reduction of the stamp duty on increase of capital, where we expect that the stamp duty should increase. But we've talked about some of the conditions for that to happen, where we're saying that there must be a new company incorporated in Kenya for that to be affected, or increase in the share capital of an existing company in order for one to be liable for an exemption or a reduction of a stamp duty. We've also emphasized that the absorbing company is either registered or increased in share capital with a view of acquiring 90% of the share capital of the target company. If they tend to get another company, they should acquire above 90%. Then we said 3, that consideration of transfer consists of more than 90% of shares issued to the transferee company in order for it to qualify for what we call exemption, not being charged stamp duty or a reduction in the stamp duty. Then lastly, we've talked about Section 96, and on Section 96 we've said exempt from tax instrument in respect which is shown to satisfy the collector. So we started with 1, we say effect of transfer or beneficial interest in property from one company to another. Either 1, we say that one of such companies is beneficial of owner of more than or not less than 90% of the issued capital as one condition. Then 2, we said not less than 90% of the issued share capital in each of the company is in beneficial ownership of a third company which is with limited liability. We say, when you say limited liability, it is not liable for all the things that happen. Then lastly, we've talked about that the instrument was not executed in connection with the arrangement under. And that arrangement, we said, consideration, when you talk about consideration of transfer, was to be provided directly or indirectly by a person other than by a person, which is a natural person, other than what you call the company, which is an artificial person, which is at the time of execution of instrument was associated with transferor or transferee. So that marks the end of disposal of business and restructuring activity.
Greetings and welcome back, candidates, to the lesson. The subject is public finance and taxation. The topic is public debt management. Today we are going to discuss the objectives of debt management in public sector. So by the end of this lesson, we should be able to explain the objectives of debt management in public sector. And effective debt management is a critical component of a sound fiscal management and macroeconomic stability. Public debt management is critical, and governments in managing their debt pursue several key objectives aimed at ensuring financial sustainability and supporting broader economic goals. So these objectives are often interconnected and require a delicate balance in order to achieve them. It is like a skill. It requires those who are managing the finances of the government to have this skill in order to ensure what we call sustainable financial and broader economic goals. So what are these objectives of debt management in the public sector? That's what we intend to achieve or to do in our today's lesson. Now, the first objective of debt management in public sector is to ensure that the government's financing needs and its payment obligations are met at the lowest possible cost over the medium to long term, consistent with a prudent degree of risk, to ensure the government's financing needs and its payment obligations are met. Ensure financing needs and payment is to ensure the government's financing needs and its payment obligations are met. Obligations are met. And the financing needs or these obligations or the loans should be at the lowest possible cost over the medium term to the long run, consistent with the prudent degree of risk. And this is often cited as the main objective. It emphasizes obtaining the necessary funding for the government operations and the government investments while minimizing the burden of debt servicing on the budget, but without taking on excessive risks that could jeopardize financial stability. So the primary objective is to ensure that government's financing needs and the government's payment obligations are met at the lowest possible cost over the medium to the long run. That is point number one. The second objective is to manage risks inherent in the government's debt portfolio. To manage risks. We know that there are those risks that are inherent in the government's debt portfolio. To manage risks inherent in government's debt portfolio. To manage risks inherent in government's debt portfolio. Now, public debt portfolio is exposed to various risks, including interest rate risks, which is a change in interest rates affecting debt servicing costs. We may have the currency risk. The currency risk is the risk of fluctuations in exchange rates affecting the cost of foreign currency denominated debt, and also the refinancing risk, which is the risk of not being able to borrow to repay maturing debt. You understand? So the objective of managing debt in the public sector is to manage these risks. Do you understand? And effective debt management seeks to identify, to measure, and also to mitigate these risks through appropriate debt structures and instruments. That is the second objective. The third objective of debt management in public sector is to promote a development of an efficient government securities market. To promote the development, it is to promote the development of an efficiency, to promote the development of securities market. To promote the development of an efficient securities market, an efficient securities market, an efficient government securities market. Because a well-functioning domestic debt market can promote a stable and reliable source of financing for the government, which then reduces reliance on external borrowing and then contributes to the development of the broader financial sector. And debt managers play a role in issuing a range of securities, promoting market liquidity, and also fostering a diverse investor base. So the third objective of the debt management in public sector is to promote the development of an efficient government securities market. That is point number 3. Objective number 4 is to ensure debt sustainability. To ensure sustainability. To ensure debt sustainability. This involves managing the level of debt and also the composition of debt in a way that the government can meet its current and future debt obligations without compromising its ability to finance essential public services or requiring disruptive fiscal adjustments. And this objective has become increasingly important in the context of rising global levels of debt to ensure debt sustainability. 5, candidates, we are discussing the objectives of debt management in the public sector. The 5th goal is to ensure the sharing of the benefits and costs of public debt between current and future generations. To ensure the sharing, of benefits and costs of debt between the current and future generations. To ensure the sharing of benefits and costs of debt between the current generation and future generation. Because debt incurred today will need to be serviced and repaid by future taxpayers. And therefore, debt management decisions should consider the long-term implications and aim for a fair distribution of the burden across generations. The current generation should not take debts that will be a burden to future generations. No, there should be that sharing of the benefits and also the cost of debt between the current generation and the future generation. That is the 5th objective of debt management in the public sector. The 6th point or objective is to support the government's fiscal and monetary policies. Monetary policies. To support the government's fiscal and monetary policies. So the debt management operations can have an impact on liquidity in the financial system and also interest rates. And therefore, there is need for coordination with the monetary policy. So debt management operations can have impact on liquidity in the financial system and interest rates, and therefore need to be coordinated with the monetary policy. Similarly, debt management is closely linked to fiscal policy because it deals with financing budget deficits and managing the overall level of government debt. So these are 6 core objectives of debt management in the public sector. The first objective is to ensure financing needs and payments and government's payment objections are met. And they ought to be met at the lowest possible cost over the medium to long run, consistent with the prudent degree of risk. The second objective is to manage risks that are inherent in government debt portfolios. 3 is to promote the development of an efficient government securities market. Number 4 is to ensure debt sustainability. 5 is to ensure the sharing of the benefits and costs of debt between the current and future generations. Number 6 is to support government's fiscal and monetary policies. So these are 6 objectives, and achieving these objectives requires a clear legal and institutional framework. It requires a well-articulated debt management strategy. It also requires strong analytical capacity to assess costs and risks and to effectively coordinate. It also requires effective coordination among the relevant government institutions, including the Ministry of Finance, the Central Bank of Kenya, and all that. So thank you for attending the lesson on objectives of debt management in the public sector. I'll meet you in our next session where we continue to share knowledge under the topic public debt management. If you have any questions, we allow questions. Below this video, there is a comment section where you can post your questions and all your questions will be answered. Bye.
We pick up from where we had left on the tax risk management. The number of things that we basically observed, we talked about approaches to comprehensive tax policy, providing clear guidelines and detailed training on tax requirements. We also talked about strengthening of the tax policy, and that we say that with a robust governance framework, define tax principle, and after defining those tax principles, stick to them. We say stick to them, and we say that analyze your tax risk considering both known and unknown, then you manage the risk. I want to define what you mean by tax risk. I want to define what you mean by tax risk. Anytime we talk about risk, we are basically saying is a potential of something negative occurring, and risk is all over. So we say that refers to the potential, refers to what you call a potential exposure of an individual or business. Potential of exposure of an individual or business faces. We say faces in relation to what we call to the tax laws. In relation to tax laws. So that is what we call a potential exposure that individual or business faces in relation to tax laws and regulations. Tax laws and what we call and regulations in relation to the tax laws and what we call regulations and regulations with possibility, with what we call possibility, with a possibility, we call it with possibility of what we call incurring, with the possibility of incurring what we call the financial losses, with the possibility of incurring what we call financial losses. Apart from financial losses, we have penalties, comma, interest. We have what we call penalties, interest, or lastly, or what we call legal, consequences. As a result of what we call error, omission, and non-compliance of tax. As a result of error, omission, or what we call non-compliance of tax. As a result of what we call error, omission, or the non-compliance of tax. Those are what basically risk that one faces. We could face risk as a result of the tax law, not adhering to tax laws. And those risks can result into what we call possibility of a financial loss. They can also lead to penalties, interest. But at the same time, we are saying that this can also basically lead to what we call a legal consequences. And those legal consequences basically emanates from what we call error, omission, or the non-compliance of tax law. Non-compliance of the tax law. That is what we mean by a risk. Risk is, in simple word, is simply a potential of something negative occurring. But in relation to tax, we are saying that those potential of exposure to an individual or a business is in relation to what you call the tax law and regulation, and those can lead to a number of things that we have talked about. So you go to the types of risks. We talk about types of risks. Types of what you call risks. Types of risks. So basically, when you talk about risk, there are basically two types of risk that we know. We have what you call specific risks, and then we have what you call general risks. So we can say risks are divided. Risks are divided into, we call it into two categories. Risks are divided basically into two categories. One is what you call specific risks, and then we have what we call general risks. So we have specific risk, and then we have what we call a general risk. So we start with the first one, what we call a specific risk, and get to understand what a specific risk is. So when you talk about what you call a specific risk, these are basically risks that are associated with certain situations, what you call certain situation, issue, or transaction. The basically risks that are associated with what you call a certain situation, certain issue or transaction. We call them risk. Specific risks. We say it refers to the risk associated, we say associated to what we call a particular situation, issue or transaction, or what you call transaction, issue or a transaction. So we move to what we call specific risk. We have a number what you call transaction risk, and then we have what you call operational risk. When you talk about transaction risk as the first one, examples include, we just say examples includes, one we call it transactional risk. And when you talk about transaction risk, we say is a tax risk, is a tax risk associated, tax risk associated, we call it associated with what we call a particular transaction, associated with what we call a particular transaction. And when you talk about a transaction, e.g., for example, acquisition, what you call acquisition, or what you call disposal of what you call a business, associated with what you call acquisition, or what you call a disposal of business, or part of a business. So then we have the second type, we call it operational. Operational risk. So particularly when you talk about operations, operations are day-to-day activities. So basically when you talk about operational risk, we know that risk in applying tax law as a routine. These are risks that emanate as a result of applying the tax law as a routine. So say risks that emanates, we say that risks that emanate as a result, we call as a result of what we call of application of what we call tax laws, applications of tax law, risks that emanate as a result of application of tax law to routine, on routine, or what we call day-to-day activities, or what we call day-to-day activities. Risks that basically emanate as a result of applying what we call tax law or on a day-to-day activity. Then you can also have what we call number 3, we call it transaction specific risk. We call it compliance risks. We call it the compliance risk. So compliance this is basically when you talk about compliance in adherence to the law. When you talk about compliance, it's basically in adherence to the law. So we say that related to failure to file returns, related to failure, what we call failure to file return, or what we call or pay taxes. Related to failure to file return or pay taxes, which can lead to two things, which can lead to two investigations, which can lead to two investigations, which can lead to the two investigations, which can lead to two investigation, either what they call criminal investigation, or what we call it civil investigation. And so for the compliance can basically lead to what they call civil or criminal investigation. Criminal, we know that criminal, we basically understand that criminal investigations, investigation come as a result of what they call tax evasion. So when you talk about criminal investigations, this basically emanates as a result of what we call tax evasion or fraud, which is investigated, which is investigated by what we call tax authority, which is investigated by tax authority and taken to court. When taken to the court. So those criminal cases basically goes to the court and prosecution taken to the court. That is what we call criminal investigation. But for the civil tax investigation, done when unintentional civil investigation occurs as a result of what we call unintentional errors, occurs as a result of what we call unintentional errors and omission and omissions, we call it discovered in the tax return. So we call it civil investigation occurs as a result of what we call unintentional errors or omissions that are basically discovered in the tax return. These are not as severe as what we call not as severe as what you call the criminal investigation. So then we have what you call, lastly, on specific risk. We call it that should be, we had the specific risk. Specific risk. We have discussed transactional, operational, and what you call compliance. And so the last one, we call it financial accounting risk. What you call financial. That should be 4. What you call financial. We call it the financial accounting. Financial accounting risks. What you call the financial accounting risk. When you talk about financial accounting risk, related to internal control and accounting system. So this one related to what you call internal control, and what you call internal control, related to internal control and accounting systems, and what you call the accounting system, and what you call the accounting systems. So basically related to the internal control and what you call the accounting system. So then we proceed to the second type of a risk. We call it the general. We call it the general risks. We call it the general risk. So when you talk about the general risk, we're basically saying risk generally apply to most risks that generally apply to most taxpayers. We say that these are basically risks that generally applies to most of the taxpayers. And when you say most, majority of the taxpayers, and are common to most, they include they basically include about 2. They basically include one we call management tax risk. Management tax risk. Management tax risk. Reputational, what we call reputational tax risk. So we have the management and what we call the reputational tax risk. The management and what we call the reputational tax risk. And the general risk, we have said, include what we call the management tax risk and what we call the reputational tax risk. So we proceed to the management tax risk. We explain that. The management tax risk starts with what we call the management tax risk. Tax risk. Proceed to what we call the management tax risk. And we know for sure risk, if of not, refers to the risk of what we call of not properly managing. So refers to the risk of not properly managing, the tax risk of not properly managing. Other risks, we call it other risks. We call it properly. Other risk properly, of managing what we call other risk properly, or failure to have a tax risk management policy, or failure to have what we call a tax risk management policy. Tax risk management policy. So then we proceed to what we call reputational tax risk as the second. When it comes to reputational, that is basically on the name. Reputation taxes, it is wider. We say it is wider. When you talk about reputational, it is wider. We say that basically it is wider. Impact on organization, wider impact on what you call the organization. Wider impact on the organization. If it's tax knowledge, if what do you call it? It's tax knowledge. If it's tax knowledge, basically if it's tax knowledge, becomes a matter of what you call the public knowledge. Becomes a matter of what you call the public knowledge. I want us to proceed to what you call factors considers when developing. Factors considered when developing a tax risk. Factors that are basically considered when developing a tax risk. Mitigation strategy. Mitigation strategy. Factors that are basically considered when we talk about developing what they call a tax risk mitigation strategy. We have one of the factors. One is the potential. We call it the potential of risk. Potential of the risk. One of the factors is potential of the risk. If it occurs, potential, we just say potential impact of the risk. Impact of the risk if it occurs. If basically it occurs. So if the risk occurs, what is the likely impact of the risk? If the risk in question basically occurs, what is the impact of the risk? So that is what you call the potential impact of risk if basically it occurs. Then we can talk about urgency of addressing the risk. How urgent do you need? How fast do you need to address the risk? That is what we call urgency of addressing the risk. We call it the urgency of what we call of addressing what you call the risk. Urgency of addressing the risk. Urgency of addressing the risk. Estimated cost. What you call estimated. The other factor is what you call estimated. Estimated cost of what you call of mitigating what you call the tax risk. Of mitigating what you call the tax risk. So the cost that basically is involved in mitigating what you call tax risk, and that is specific. You just say specific risk. Specific risk. Specific risk. What is the cost in terms of finances? How much finances is basically needed to mitigate that risk? Resources available to the organization. We call it next is resources. Resources available to the organization. What we call to the organization. Resources available to the organization. Then lastly, what we call the risk appetite. We call it the risk appetite of the organization. The risk appetite of the organization. The risk appetite of the organization. Just to emphasize on what we've done. Factors that one needs to consider when developing what we call a tax risk mitigation strategy is the potential impact of the risk if the risk occurs, the urgency, how fast do you need to address the risk, estimated in terms of financial cost. How much does it basically involve to mitigate the risk? Then we have what we call resources available to the organization, because remember, these resources are what is required to mitigate the risk. Then again, the risk appetite of the organization. I want us to discuss the benefits of integration, what they call benefit that results from integration of departments. Integration of department. When we talked about risk mitigation, we talked about aspects where we talked about a good approach has to be comprehensive tax policy. We also talked about what we call comprehensive tax policy, provide clear guidelines and details on training, tax requirements. We also talked about strengthening policies with a robust tax governance, define your tax principle and stick to them. We also talked about what we call analyzing the tax risk, both known and unknown, and we've talked about those risks and manage the tax risk. So I want us to talk about what we call benefit as a result of integration. We talked about benefits as a result of integration, what we call integration. Benefits as a result of integration of departments, integration of departments, benefits as a result of integration of departments, as a result of integration, bringing departments together into domestic tax department, into the domestic tax department, into the domestic tax department. So what we call the benefits are as a result of integration of departments into the domestic tax department. What is basically integration? Integration, we basically say, is bringing together. So one of the benefits, we know that integration has basically eliminated what we call duplication of functions. When you talk about this, it has eliminated, when you bring functions together, it has eliminated duplication. One, you take eliminated, what we call the duplication of functions. You know, the functions that are more similar. So when you bring departments together, you're basically eliminating what you call duplication of function, leading to resources saving, leading to what you call resource saving that can be applied in what you call critical areas. So when departments are integrated in the domestic tax department, it basically leads to elimination of what you call duplication of function. Then we talk about what we call, it has led to enhanced tax, led to what we call enhanced tax, led to basically enhanced taxpayers compliance. Enhanced taxpayers compliance has basically led to enhanced taxpayers compliance and risk assessment, and what we call risk assessment. As a result of integration, we know that it taxpayers compliance and risk assessment, given the taxpayers monitored from all taxes, given that taxpayers are monitored for all taxes. We know that taxpayers are monitored for all taxes as a result of integration. The next, we can talk about there is better relationship with client as they are no longer subjected to separate audit. Better relationship with clients, better relationship with clients as they are no longer as they are no longer subjected to what you call separate audits. So better relationship with the client as a result of the no longer separated to separate audit. Maybe you have VAT alone, this alone, but you have them together. Audit from incomes and VAT, i.e. from income, from what you call income tax, and what you call VAT, and VAT officers. So we have one audit, but not separate audits. Then we can say this as the next advantage. We can talk about information sharing as a result of integration. We know that information sharing is possible. When you bring department together, we have the next as what you call information. We call it information sharing is what you call is possible. Information sharing is basically possible. Information sharing is what you call possible. Information sharing is possible. But we can also talk about management is able to monitor effectiveness of tax audit and other program. Management is able to monitor. Management is able to monitor what you call the effectiveness. Effectiveness. It's right here. Is able to monitor the effectiveness of tax audit, and other programs. And why is that possible? That is possible because there's the aspect of integration. That information is basically in one point in totality, as opposed to previous situation. In totality, we say as opposed to the previous, as opposed to what you call the previous system. So those are basically the benefits of integration of departments in domestic tax department. We can also look at drawbacks. Those are the negatives of integration. We call it drawbacks from integration. Drawbacks or disadvantages. Drawbacks from integration. Drawbacks from integration. What are the negatives of integration? That is what you call a drawback. Lack of clear responsibility. What you call lack of when you integrate. We basically say one is lack of what you call of clear. We call it the clear responsibility. Lack of what you call clear responsibility. What you call lack of clear responsibility. So we know that previously it was possible for attaining targets on various commissioners, like the custom and excise, but now with investigation, it is not possible. It is now not possible because all these are basically integrated in one. That previously we know that you could get information on custom and excise, but now with the integration, that is not possible. So lack of clear responsibility as the first drawback. Then we talk about what we call inefficiency may crop due to increased span of management. Inefficiency may crop in as a result as a result of what you call, as a result of increased span, increase span, because of the span of management. So the management basically becomes very wide. Increased span of management, that may result into a drawback in efficiency span of management by who? By the supervisors. That may lead to inefficiency when management have to cover a larger area by supervisors. By the supervisors. That is one of it, by the supervisors. Then we can talk about what you call lack of specialization. Lack of specialization, because why lack of specialization? Specialization is basically when staff are doing what they're very good in. But when there's an aspect of integration, then now staffs are going to handle what you call diversity. They're handling this and that altogether. So basically specialization will be missing. Lack of what you call of specialization. Since what you call the staff will be handling diversity. Since the staff will be handling what you call diversity, many things at once. Lack of specialization. Staff will be forced basically to learn again, because they will be integrated to other departments. Staffs will be forced to relearn since they will be forced to learn, since they will be required to learn operations of other departments, since they will be required to learn operations of other departments, since they will be required to learn operations of other departments, since they will be required operations of other department. Loss of jobs for some of the staff as a result of those operations being merged. We say loss of jobs. Lastly, we can say loss of jobs as a result of operations, as some staff will lose jobs, when operations will lose jobs from each merged departments. So some of the staff definitely will lose jobs as a result of merging various departments. So that marks the end on what you call tax risk management.
Hello, candidates. Come back to the public taxation learning session. We're still on the first chapter, Introduction to Public Financial Management. We are now moving to the last subtopic, which is the role of the National Treasury and county treasuries in the public finance management in Kenya. The role of the National Treasury at the national level, then you have county treasuries at the county level. And we are all aware that Kenya runs a devolved system of government. And in Kenya's devolved system of government, the management and control of public finance are shared between the National Treasury and the respective county treasuries as stipulated by the Constitution and the Public Financial Management Act of 2012. So each entity plays a crucial, albeit distinct, role in ensuring the prudent and effective utilization of public resources. So in this lesson, we'll be studying the role of, first of all, the National Treasury. So we begin with the National Treasury. What is the role of the National Treasury in public financial management? What is the role of the National Treasury? Now, the National Treasury, first of all, is the principal government entity responsible for all overall management of national public finance and for providing leadership and guidance on fiscal matters to both levels of government. So it is the principal government entity responsible for the overall management of national public finances. It is also the National Treasury that provides leadership and guidance on fiscal matters to both levels of government. So in this lesson, we are highlighting, first of all, the role of the National Treasury. Now, the first role that the National Treasury plays is formulating the national economic and financial policy. National economic. The Treasury formulates national economic and financial policy. It formulates national economic and financial policy. It is responsible for developing macroeconomic policies, including fiscal policy, which sets the overall direction for government revenue and expenditure. That is the first role, formulating national economic and financial policy. The second role is preparing the national budget. Preparation of the national budget. Preparing the national budget. The National Treasury is tasked with the crucial role of preparing the annual national government budget, which outlines anticipated revenue and proposed expenditures for ministries, for departments, and also government agencies. Preparation of the national budget. Role number 3 is managing national government revenue and expenditure. Managing national government revenue and expenditure. Managing national government revenue and expenditure. The Treasury oversees the collection of national government revenues and authorizes expenditures from consolidated fund and other national public funds. Managing national government revenue and expenditure. We are moving on to the fourth role of the National Treasury in public financial management, which is managing public debt. Managing public debt. It is the National Treasury that manages the public debt. It is responsible for managing the national government's borrowing, including both domestic and external debt, and ensures that the borrowing is sustainable. Borrowing is sustainable. The fifth role is setting government accounting standards. Setting government accounting standards. Setting government accounting standards. The National Treasury formulates and maintains accounting standards and systems to be used by all national government entities, which promotes uniformity and accountability in financial reporting. Another role is in relation to revenue collection, which is oversight over revenue collection. Oversight over revenue collection. Oversight over revenue collection. It has oversight responsibility over entities responsible for collecting national government revenue, such as the Kenya Revenue Authority. Number 7, the 7th role is strengthening financial and fiscal relationships with the county government. Strengthening financial and fiscal relations. Government. Strengthening financial and fiscal relations with county governments. The National Treasury plays a key role in what we call intergovernmental fiscal relations, including the preparation of the annual division of revenue bill and the county allocation of revenue bill, which determine the equitable sharing of national revenue between the two levels of government. Point number 8 is building capacity in county governments. Building capacity in county governments. Building capacity in county governments. The National Treasury is mandated to assist county governments in developing their capacity for efficient, effective, and transparent financial management. Then number 9 is monitoring and evaluation. Monitoring and evaluation. Monitoring and evaluation. The National Treasury monitors and also evaluates the financial and economic performance of the national government and provides reports on the same. The 10th role is administering national public funds. Administering national public funds. National public funds. The National Treasury is responsible for the administration of the national public funds, including the Consolidated Fund, the Equalization Fund, and the Contingencies Fund. So these are 10 roles of the National Treasury with respect to management and control of public finance. Let's move to the county treasuries. County treasuries. County treasuries. Now, county treasuries are established in each of the 47 counties in Kenya and are responsible for managing the public finances and economic affairs of the respective county governments. And their roles mirror some of the functions of the National Treasury at the county level, which include developing and implementing county financial and economic policies. The first role is developing and implementing economic and national and county economic, that is developing county financial and economic policies. County financial and financial. So these roles mirror the National Treasury roles, but at the county level, developing and implementing county financial and economic policies. County treasuries are responsible for formulating and implementing the financial and economic policies relevant to their specific county context, aligning with the national policies. Second role is preparing the county budget. Preparing the county budget. They are responsible for the preparation of the annual county government budget, outlining the planned revenue and also expenditure for the county departments and county entities. The third role is managing county government revenue and expenditures. Managing county government revenue and expenditure. Managing county government revenue and expenditure. County treasuries oversee the collection and that is collection from they oversee the collection of county government own source of revenue, and also manage expenditures from the county revenue fund and other county public funds. So managing county government revenue and expenditures. It is the county treasuries that oversee the collection of county government's own source revenue. They also manage expenditures from the county revenue fund and other county public funds. The fourth role is managing county public debt. We are mirroring these candidates. Mirror. Okay. What happens at the National Treasury in relation to management of national government funds, it also happens at the county level. Number 4 is management of public debt. This is the management of national debt. When it comes to county treasury, the county treasuries manage the county debt. Managing county public debt. County public debt. Now, subject to national legislation and regulations, county treasuries manage the borrowing activities of the county government, but they are subject to national legislation because we know counties have limited power to borrow. We will be studying later on that before county governments borrow, the loans that they borrow must be guaranteed by the national government. So county treasuries also manage county public debt. That is the fourth role. The fifth role is maintaining county government accounting records. Maintaining county government, number 5. Maintaining county government accounting records. Maintaining county government accounting records. They are responsible for maintaining proper accounts and records of the county government's financial transactions in accordance with the standards set by the National Treasury. 6. Ensuring compliance with financial regulations. County treasuries ensure compliance with financial regulations. County treasuries are crucial in ensuring that all county government entities comply with the Public Finance Management Act, the financial regulations, and other relevant financial laws and circulars. Moving on to the 7th role is the monitoring and evaluation. Monitoring and evaluation of county finances. Monitoring and evaluation of county finances. County treasuries monitor and evaluate the financial performance of the county government and its entities. 8. Reporting to the county assembly. The county treasuries also report to the county assembly. County treasuries are accountable to their respective county assemblies and are required to submit financial reports, including budget estimates, budget and outlook papers, and also financial statements for scrutiny and approval. Then number 9, providing financial advice. Providing financial advice. The county treasuries advise the county executive committee and the county assembly on financial and economic matters. So these are the roles of the national treasury and county treasuries with respect to management and control of public finance. We started with the role of the national treasury, and we stated that the national treasury is the principal government entity responsible for the overall management of the national public finances and for providing leadership and guidance on fiscal matters to both levels of government. The first role is formulating national economic and financial policy. Number 2, preparing of the national budget. Number 3, managing national government revenue and expenditure. Number 4, managing public debt. Number 5, setting government accounting standards. Number 6, oversight over revenue collection. Number 7, strengthening financial and fiscal relations with county governments. Number 8, building capacity in county governments. Number 9, monitoring and evaluation. Number 10, administering national public funds. Then county treasury roles include 1, developing and implementation of economic and financial policy. Number 2, preparing the county budget. Number 3, managing county government revenue and expenditure. Number 4, managing county public debt. 5, maintaining county government account records. Number 6, ensuring compliance with financial regulations. 7, monitoring and evaluation of county finances. Number 8, reporting to the county assembly. And lastly, providing financial advice to the county assembly and also to the county executive committee. That's all, candidates. In closing, it's important to note that while the National Treasury provides the overarching framework, policy direction, and oversight of public finance management in Kenya, the county treasuries are responsible for the day-to-day management and control of public finances within their respective jurisdictions, ensuring that resources are mobilized and utilized effectively to deliver services to the citizens at the local level in line with the principles of the Public Finance Act of 2012. That is all for today's lesson. If you have any queries, candidates, you are free to ask questions below this video. There is a comment section where you can post your questions and all your questions will be answered. Bye-bye.
We proceed with our series on tax planning. But to be very precise, we talk about tax avoidance and anti-tax avoidance provision. We did say that tax avoidance is what we call a legal way in which to reduce the tax payable to KRA. So when you talk about tax avoidance, that is a legal means through which one reduces the tax payable to the Kenya Revenue Authority, or arrangement of taxpayers' affairs in such a way that they are able to reduce the tax payable to the Kenya Revenue Authority without contravening the law. That is what we call tax avoidance. Then what is tax avoidance provisions? Tax avoidance provisions. Tax avoidance provisions. So when you talk about tax avoidance provision, the sections of the law that basically empowers the commissioner to reject certain transactions that are basically done with the aim of reducing the taxes. And that is, to be precise, that is section 23 and what we call section 24. Section 23 basically talks about, the commissioner is basically empowered to reject certain transactions that are geared or that are purposed with an intention of reducing the tax payable. Section 24 talks about shortfall distribution of dividends. That is basically to curb revenue incomes that are from untaxed sources. The incomes that are basically from untaxed sources. So we say provision through tax avoidance is legal. Legal means it is allowed by law. Though tax avoidance is legal. Income Tax Act empowers the commissioner. To reject. Empower the commissioner to reject some transaction with an intention to reduce the tax payable. Empowers the commissioner to reject certain transactions that are geared to reduce the tax payable. So we talk about those two provisions. We have Section 23. And Section 23, as we've said, it basically empowers the commissioner to reject those transactions that are basically aided to reduce tax, certain expenses that are basically geared to reduce the tax payable. And Section 24 is on the shortfall distribution of dividends. So Section 23, we say that this empowers the commissioner. This empowers what we call the commissioner. This basically empowers the commissioners to reject some expenses, stroke transactions with the purpose of reducing what we call the tax payable. Basically empowers the commissioner to reject those expenses or transactions that are basically meant to reduce the tax that is payable. I.e., what are the examples of these transactions? Overpayment of salaries to relatives. For example, overpayments of salary, i.e., overpayment of salary to relatives. The impact of this when you overpay salary to a relative is that the impact of this is basically raising what you call the allowable expense, meaning at the end of the day is that the tax that is supposed to be paid is going to be low to relative or minor to relative for minor duties. Duties that are not worth that, and then you give them huge amount of cash to reduce the tax payable. Then we have Section 24 of what we call of Income Tax Act. Section 24 of the Income Tax Act. Section 24 of Income Tax Act is now talking about shortfall distribution of tax to prevent flow of income from untaxed sources, from untaxed sources. So that's basically talking about deal with shortfall distribution of tax. We say deals with shortfall distribution dealing with the shortfall distribution of income. Shortfall, just one word, shortfall distribution of tax, of income, income, shortfall distribution of income, what they call the shortfall distribution of income by company. That is a shortfall distribution tax. So that is section 24. And that was basically also handled in our calculation. So that is basically on tax avoidance and tax avoidance provision. Welcome to Manifested e-learning platform. We are still continuing with our December 2024, that is public finance and taxation. Today we are covering question 4. And when you look at question 4, we have question 4A, B, and C. So we begin with question 4A. So we're being told that identify 4 circumstances under which the Revenue Authority could cancel a PIN, or what you call personal identification number in full. So we're saying that basically the number of scenarios that Kenya Revenue Authority would cancel a PIN. One, we say that in case of death of a natural person, in case a company has been liquidated, and we also say that in case a PIN has been issued to a person under an identity that is not a true identity of the person, when a person had been issued with another PIN and the PIN is still in force, that will lead to cancellation of a new PIN that has been issued. So we can put down this point. So we say 1, in case of death of a natural person, we have number 2, in case a company has been liquidated. In case a company has been liquidated. In case, say, a person had been issued with a PIN, and the PIN is still in force. In case a person had been issued with a PIN and still the PIN is in force. So when another PIN is issued, that would automatically lead to cancellation of the PIN. Then when a person is issued with a PIN that does not bear the true identity of that person. So when a person has basically been issued with a PIN and the PIN does not bear what we call the true identity, of that person. Then we have circumstances where a taxpayer notifies the Commission of Domestic Tax that he no longer needs the PIN, and basically on that condition, he qualifies the set conditions for that he qualifies for. When a taxpayer notifies the commissioner that he or she no longer needs the PIN. He or she no longer needs the PIN for transaction and you say on meeting what you call the set conditions. You not just move from a PIN without meeting the set conditions. So you notify the Commission of Domestic Tax that you no longer need the PIN, but you only qualify when you basically meet the set conditions. So we move to B. That is question 4B. So we're being told on B, summarize four reasons why the government in your country levy taxes. The varied reasons why the government would basically levy taxes, one of it, and one important reason is to raise the taxes, to raise revenue. So we say the government levy the taxes in order to raise revenue. So we all understand that one of the major reasons for taxes, for levying taxes, is basically to raise what you call revenue. Then we have what you call social welfare. Whenever we talk about social welfare, this is basically protecting the citizens from consuming commodities that are considered to be harmful. To prevent the consumers from consuming commodities that are considered, we say harmful, that are considered harmful to their health. That is the social welfare, that are considered to be harmful to the health. So we have what we call economic stability. Economic stability. And in economic stability, when we look at aspect, what we call inflation, and inflation is what we call the persistent rise in the prices of commodity. We basically call it persistent rise in the prices of commodity. We all understand that during inflation, what happens is that we raise the taxes to bring economic stability. During inflation, the government raises taxes to bring economic stability. Then we have the next. The taxes lead to what you call optimum allocation of resources. Another reason why taxes are being levied is basically to bring what you call optimum allocation of resources. So whenever taxes are raised, taxes are basically raised to bring what you call maximum allocation of the resources. And lastly, we can add one for that case. We call it protection policy. Protection policy. So when you talk about protection policy, the government can basically use taxes to protect the local industry. For example, the government may raise custom duty to make it expensive, basically to import goods from outside the company, outside the country, and therefore making goods within the country cheaper. So protection policy, the government normally raises import duty to protect the domestic industry from what we call unfair competition. Normally does that to protect the local industry from what we call unfair competition from outside the country. So that is how we essentially handle, that is B, the reasons why the government levy taxes. So we proceed to C. So we're being told that Adam Milmwema, a retired engineer, set up a manufacturing factory in industrial area on 1st January 2023 to fabricate commercial and automotive parts at a cost of 44,900,000. Operation commenced on 1st January 2023, except for the commercial building, which was put to use from 1st September 2023. So being told that the cost of manufacturing comprised of the following. So we have the factory building, that is a figure of 18 million. We have office within the factory, that should be 800,000. We have the second-hand imported machinery, the figure is 4.4. We have land, the figure is 8 million. We have engineer's fee for machine installation, 1.4. Then you have parking bay, the figure is 900,000. We have conveyor belt, the figure is 1.4. Then finally, we have the commercial building, the figure is 10 million. So additional information, we're being told that the commercial building cost include the following. So we have the showroom. On that commercial building, there's a showroom. There's a retail shop, a showroom and a retail shop. So a showroom is a figure of 2.8, and a retail shop amounts to 3.2. So then you're being told that factory building cost basically included a warehouse, that is 2.2. Then you have a building that had been constructed at a cost of 12 million, was leased from Juhudi Manufacturers Limited for 5 years. The annual lease was agreed to be 2.2. Adam Mill imported machinery from China at a cost of 5.2 and installed it in the building and started operation on 1st January 2023. To improve the performance of the factory, Adam Mill Mwema on 1st July computerized operations at a cost of 15 million, out of which 30% was software. Then you're being told that the following assets were purchased on 1st July. That is furniture and fitting. The figure is 620. We have a second-hand BMW. The figure is 4.3. We have 4-ton lorry. The figure is 1.8. Then we have a backhoe loader. The figure is 3,680,000. Then finally, we have what you call a mobile crane. A mobile crane is a figure of 1,900,000. So then we're being told that on additional information number 6, that factory staff quarters were constructed during the year at a cost of 2,250,000 and put to use from 1st October 2023. Then required compute investment allowance due to Adam Mwema for the year ended 31st December 2023. So we begin the analysis of the question. So we're being told that this gentleman called Adam Mwema, who is a retired engineer, he has set up a manufacturing factory in industrial area, that is from 1st January 2023 to fabricate mechanical and automotive parts at a cost of 44,900,000. Operation commenced on 1st January, except for the commercial building, which was put to use from 1st September. So we look at factory building. We know that factory building, number one, which kind of investment allowance does it qualify for? It qualifies for what we call investment deduction, that is the ID. Then office within the factory qualifies for what we call industrial building deduction, that is IBD, at the rate of 10% on a straight line. For the factory building, 50% in the first year and 25% straight line from the second year on the remaining balance. Second-hand imported machinery, that also qualify for ID at 50% in the first year. Then we have land. Land does not qualify for any investment allowance. Then we have engineer's fee for machine installation, that will qualify for ID at 50%. Parking bay will also qualify for ID at 50% in the first year. Conveyor belt, again, that will also qualify for ID at 50% in the first year. Then you have the commercial building that should be IBD, industrial building, at the rate of 10% on a straight line. So we pick it on additional information. So when you look at that commercial building, commercial building is 10 million. Commercial building is 10 million. So out of that commercial building, we have a showroom. So we can list the showroom. Showroom is 2.8. Then you have what you call retail shop. We have a retail shop. The figure is 3.2. So basically, when you list that, we have the commercial building. When you deduct that, we have the commercial building, or you can have it as a whole as commercial building. That should be 4 million. 4 million. Commercial building should essentially be 4 million. So then working 2, we have the factory building, includes a warehouse of 2.2. So we can do our second, we call it working 1. We have working 2. A factory building, we look for factory building. So we have the factory building. We are given a figure of 18 million. We less the figure of 2.2. So the figure that we have is 15,800,000. We have a figure of 15,800,000. How do I get it? We less the warehouse, because warehouse qualify for IBD. So this warehouse is going to basically qualify for IBD at 10% on a straight line. So then we're being told that a building that had been constructed at a cost of 12 million was leased from Juhudi manufacturers for 5 years. The annual lease rental was agreed to be 2.2. Adam Mwema imported a processing machinery from China at a figure of 5.2 and installed it in the building. When we lease a building from another person, we cannot claim investment allowance. That's why, as a tax person, instead of leasing, you should buy in order to qualify for investment allowance. In this case, it's only going to qualify for lease rental, but not investment allowance on the building that has been leased. However, for the machine that has been imported from China, the 5.2, that is going to qualify for ID at the rate of 50% in the first year. Then you're being told that to improve the performance of operation, Adam Mwema on 1st July computerized the computerized operation at a total cost of 15 million. Then 15% was software. So we can break this down. So 15 million computers, we say computerized, times 70%, we have our calculator, times 70%, times 70%. So the figure is 10,500,000. And then we have software, these are computers, Then we have 30%. That is a computer software. So 0.3 times 15 million. So that should be 4.5. So this is computer software. That is basically what we call computer software. That is what we call computer software. So then we have the following assets were basically purchased on 1st July. The first one is furniture and fitting, that is qualifying for wear and tear at the rate of 10% on a straight line. The second and BMW, remember that is an SUVs. And you say that under investment allowance for SUVs, that is saloon cars and SUVs, if the value is more than 3 million, we restrict to 3 million. So for the BMW, we are going to restrict at 3 million and claim investment allowance at the rate of 25%. Then 4-ton lorry, that is also, we claim investment motor vehicle at the rate of 25% on the straight line. Then you have a backhoe loader. We also claim investment allowance at the rate of 25%. We have a mobile crane. We claim investment allowance at the rate of 25%. But mark this, because this is very important based on the present rates in relation to investment allowance. And a lot of students basically omit this decision. So if they were purchased initially, when you talked about the following assets were purchased on July, initially there used to be apportionment when it gets to industrial building and wear and tear. Like for example, you look at these assets that were basically purchased mid of the year, that is 1st July. Based on the present rates, we do not apportion, we claim the whole amount. If you apportion, then basically you find yourself missing entries on this particular question. So we claim the all investment allowance for furniture, for second-hand BMW, backhoe loaders, and the mobile crane. Then lastly, we have what we call factory staff labor quarters were constructed during the year at a cost of 2.2 and put to use on 1st October. We also going to claim industrial building at the rate of 10% on a straight line, but we don't apportion. We claim the whole amount. So we proceed to the question. So compute investment allowance due to Adamil for the year ended 31st December 2023. When you look at this particular question, there are basically two methods. We can have it as a whole, do it as a whole, or we can separate. But I would love us to separate for this particular question and do each separately. So we proceed. We start with investment, that is ID, investment allowance at 50%. That is the ID. So we call it Adamil. We call it the Adamil. We have it as Adamil Mwema ID. That is for the year ID for 2023. So we have the nature of the asset. We have what we call nature of what we call asset. Nature of this asset. We have the qualifying cost. We have what we call the qualifying cost. We have the qualifying cost. We have the rate. Then we have the ID, or which is the investment. We have ID, then you have residual carried down. And then you have what you call the residual carried down. So the first item that we start with is the factory building. The first item, as we pointed out, is the factory building. So the factory building was 18 million, we less the warehouse. So for the we have the factory building. Qualifying cost is 15,800,000. The rate in the first year. So ID is 50% in the first year, 25% on a straight line from the second year on the remaining balance. So the ID for 2023, that is 0.5 times 15,800. So we have 7.9. Residual, that should be 7.9. We have the figure of 7.9. So then we proceed to the next. We proceed to the next item, that is imported, second-hand imported machinery. Second-hand imported machinery. Imported machinery. Second-hand imported machinery. So for the second-hand imported machinery, that is also 4.4. 50%, that should be 2.2. 2.2. That should be 2.2. 2.2. Then you have engineer's fee. Those are costs that are incurred before the machine is to put. Engineer fee for machine. Engineer fee for machine installation. For machine installation, that is 1.4. That is 1.4. So 50%, that should be 700. We have 700. We have the figure of 700. Then you have the next, which call parking bay. Parking bay. So for the parking bay, we have also at 50% ID, that is 900,000. 900,000, 50%. That should be 450. 450. That should be 450. And then we have the balance as 450. The next item is what you call conveyor belt. We have the conveyor belt. So for the conveyor belt, we have the figure as 1.4. 1.4, 50%. That should be 700. That should be 700. That should be a figure of 700. So then we proceed to the next. We look at additional information number 3. So when we lease a building, we do not claim. We can only claim what you call the real lease rental, but you cannot claim investment allowance. That's why when you have an option, whether to buy an asset or lease, buy in order to claim investment allowance. A lot of times students, when they see the lease, they wonder why we don't put the lease value. But when you lease an asset, we cannot claim investment allowance. We can only claim what you call lease rental. Then you go to machines imported, processing machine that was imported. So we have what you call the processing machine. We have what you call the processing machine. The figure is 5.2. So 50%. So that should be 2.6. 2.6. The balance residual, 2.6. Again, as a point of emphasis on this particular calculation, if you look at this particular calculation, this is 50 IDs, 50% in the first year. However, in the second year, we grant it 25% on a straight line on the remaining balance, from the second year, implying that this figure, you are supposed to grant it for 4 years. So you're going to get 25% each for 4 years so that you claim it, but we want for 2023. So there's not an item for ID, so we get the summary for ID. So we need the summary, which called total ID, This information is very important. That is, if you need the second year, that information would be very, very important if you need for the second year. So we have the 7.9 plus 2.2. Then you have plus 700 plus 450 plus 700,000 plus 2.6. So that should be 14,550,000. 14,550,000. That is for the first part. 14,550,000. So we proceed to the next item. We go to what you call the ID. Commercial buildings. So I've done a breakdown before we get to that IBD. IBD is for buildings. IBD, remember these are buildings, but these are non-manufacturing. So we have what's called nature of the building, nature of asset, we just call it the nature of asset. Then we have the qualifying cost, we have the rate, we have ID, we have IBD, we have the IBD, and then we have what's called residual. However, these ones are on a straight line, so it should be the same. So residual, you'll only need that residual to get the balance remaining, But you know that essentially when you say on a straight line, then we basically claim investment allowance at the same rate on a yearly basis. Like this is 10%. So basically we mean that we have 10 years in order to claim investment allowance for the IBD. So the first one is commercial building. So the commercial buildings, we have showroom, we have retail shop. Remember, even if we break it, this is 1 mark for that solution. However, you can break it. We have the showroom. Showroom was 2.8 as a qualifying cost. The rate is 10%. 10%, that should be 280. That is 280. So residual from that, when you have residual from that, so when you less that, that should be 2,520,000. 2,520,000. Then you have the retail shop. We have what we call retail shop. So we have the retail shop. The retail shop is 3.2. So that should be 10%. 10%, that should be 320. 320. So when we less 3.2 minus 320, so that is 2,880,000. That, then we have commercial building. Otherwise, we would have just included, there's a 1 mark for those. We would have just said commercial building, 10 million. Still, there's not an issue. We just broke it down. And that is 10%. That should be this is 400,000. This is 3.6. This is 3.6. The figure is 3.6. So then we get the other items. So the other item is office building. We call it office building. So the office building is 800,000. 10%, that should be 80. So that's 720. The balance should be 720. Then that is 720 for the balance. So we proceed to the additional information. There is a commercial. There's a showroom that was deducted. So the showroom was not showroom but warehouse. There's a warehouse. The warehouse was 2.2. Rate is 10%. That should be 220. So 220 when you less that, 2.2 minus, that should be 1980. Then you have the last one, which you call staff labor quarters. That is 2,250,000. So that's 225,000. So we have 2,250,000 minus 225. So that should be 2,025,000. So we have that. So that is 280 plus 400 plus 80,000 plus 220 so that should be 15 to 1,525,000. That is for the IBD. Again, also an emphasis, on where most students presently, we used to apportion these figures. Like, for example, when you talk about these staff labor quotas, we used to say if it's October, November, and December, that is basically times 3 months. But with the changes, do not apportion, claim the whole amount. So then we have the last item, that is for the wear and tear. So wear and tear. So we have nature of the asset. So we have wear and tear. There's those at 10% on the straight line. And then we have wear and tear. Wear and tear. So before that, we have the qualifying cost. So that is wear and tear. Wear and tear 10%. And then we have wear and tear at 25%. Then we have residual. We have the residual carried down. The residual carried down. So we start from the first one, which we have computerization. We can have it as a whole and claim 25%, but you can talk about computers. That's on its own, but that can be as computers. That should be 10,500. So where does it qualify? It qualifies at 25. So 0.25 times 10,500,000. So we're having 26, 25. So the residual, so minus 10 million, that should be 78, 75. 75,000. Then we have computer software. Computer software. So again at 25, not 10%, but at 25, that should be 4.5. So that should be 1,125,000. 125,000. So what is the residual? So 4.5 minus that should be 33, 75,000. Then we have the next, what we call furniture and fitting. Furniture and fittings. So for the furniture and fittings, we have 620. So furniture and fitting basically falls under 10%. So the 10% of that should be 62. Again, do not apportion. So we have 620 minus 62. That should be 558,000 as the residual. So we move to the next. We have second-hand BMW. Remember, this is SUV restrict. If the value is more than 3 million, restrict to 3 million. So we have 3 million as a qualifying cost. But remember, that is under 25%. So that should be 750,000. So this should be 2,250,000. 2,250,000. So then we have a 4-ton lorry. 4-ton lorry. So we have a 4-ton lorry. That is 1.8. 4-ton lorry times 1.8. $1,350,000. 1,350,000. Then we can note what we call backhoe loader. So the backhoe loader is also 25%. The qualifying cost is at 25%. That should be 0.25 times 3680. So that should be 920. So 920, 2760. 2760. So we proceed to this end. We have what we call nature of the asset, qualifying cost, wear and tear. We have 10%, and then we have wear and tear 25%. Then you have the residual carried down. So we have the residual carried down. So we have the mobile crane, what we call the mobile. So mobile crane, that is 1.9. So that should be wear and tear 25%. So 1.9. So that should be 475,000. So minus 1.9. So that should be 14. That should be that. So we get the summary. That is for the 10%. So for the 10%, we only have one item. That is 62. That should be 62 for wear and tear. So we can go to 25%. So that should be 2,225,000 plus 1,125,000 plus 750 plus 450 plus 450 plus 920, then plus 475. So that gives us 63,45. 6,345,000. Before you get the summary, very important also to emphasize that even for the wear and tear, we used to apportion, but we no longer apportion. So you claim the whole amount. So do not apportion for the 6 months. Otherwise, that value will not have the correct entry. So investment, we have investment, allowance 2020, 2023. So we have the ID. ID was a figure of 14,550,000. We had IBD was 1,525,000. We have wear and tear, 10%. That was 62. Then we have wear and tear. 25%, being equals to 6,345,000. So this is the total investment allowance for Adamil. So we have plus 62, then plus 1,525,000, then plus 14,550. That should be a figure of 22,482,000. 22,482,000. That is for the summary of investment allowance. What is the marking point for this? The marking point is basically entries. These entries are the marking point. The entries are the marking points. The entries here are the marking points. So the marking points again are on the entries. But again, also as a parting shot, do not apportion. Even if for wear and tear, it was within the year, do not apportion. Even for IBD, do not apportion. Claim the whole amount. So that is how we tackle question for December 2024. That is the PFT. See you in another session. Welcome to Manifested e-learning platform. Today we continue with our series under specialized, and that is the compensating tax. Number one is to define what a compensating tax is. we say that compensating tax is additional tax to the limited company. And why do we impose what we call compensating tax? The essence of it is basically imposed to company to restrict the company from distribution of income from untaxed sources. So we say it is an additional tax to the limited company, additional tax to the limited company, additional tax to the limited companies, to the imposed additional tax imposed to the limited company, additional tax imposed to limited company. And you say that the essence of imposing it is basically to restrict distribution of income from untaxed sources. So you say it is usually imposed to restrict. It is usually imposed to restrict company distribution, what you call companies distribution. We say distribution of income, of what you call income from what you call untaxed sources. That is additional tax that is imposed to the limited company, and the essence of it is basically to restrict companies' distribution of income from untaxed sources. So compensating tax, we need to understand that it's derived from what we call dividends tax account. So we say that compensating tax is basically derived. Compensating tax, we say that is derived from dividends, dividends tax account, is basically derived from dividends tax account. But the compensating tax, we know that is essentially derived from dividends tax account and is required to be paid, and it is required to be, it is basically required to be paid and return filed by the 30th of the fourth month after the year of income. So we say that it's required to be paid and filed by the 30th of the fourth month after the year of income. So we need to know that required to be paid, and returns filed by the 30th, and return filed by the 30th of the fourth month, 30th of the fourth month after the year of income, after the year of income, Just a recap of what we have said. We have said that when you talk about compensating tax, is what you call an additional tax imposed to a limited company. And the essence of imposing is basically to restrict companies' distribution of income from untaxed sources. So we need to understand that the compensating tax is basically derived from what we call the dividends tax account, which is required to be paid and filed by the 30th of the fourth month after the year of income. So we need to understand that dividends tax account, what we call dividends tax account, from where compensating tax is derived. Dividends tax account from where compensating tax is derived has the following format. Has the following format. So we say that the dividends compensating tax is basically derived from the dividends tax account. What is the format we have on the format? We have the dividends tax account, what you call the dividends tax account. We have it there, dividends tax account. On that dividends tax account, we know we have on the debit side, we have the balance brought down, that is at the beginning. Tax refund, what you call tax refund. We have what you call the tax refund from KRA, we say during the year, from KRA during the year, tax refund. Those are the tax that are basically refunded by the Kenya Revenue Authority during the year. We get it on the debit side. And then we have what we call dividends paid. So dividends paid, we have dividends paid, and we multiply it by 1 minus 1. We say 1 minus T. And you know the tax is tax. We get the tax, T over 1 minus tax. We know that tax is basically 30%. So T is the tax over 1 minus tax, that is about 0.7. We have the figure, that is what is dividends that is paid. And on the debit side, we have what we call compensating tax. And in that instance, we have our credit will be more than the debit. Compensating tax, and that we call it balancing figure. We call it the balancing figure on that end. So on the debit, we have what we call corporation tax, corporation tax for the year. We have corporation tax for the year. And then the second entry on the credit side, we have what we call dividends tax account, what we call the dividends received. We have dividends received. So we multiply by T, which is tax over 1 minus T. 1 minus T, that is 1 minus T, which is 1 minus 0.7, that minus 0.3, which is taxation. We have 0.7, so we get the figure. Again, when you have instances where we have the debit side is more than the credit side, we don't have a compensating tax, but we'll be having balance carried down. We will be having what you call the balance carried down, and that is the balancing figure. We'll have the balancing figure, and we have that figure. So that is the dividends tax account. So compensating tax, we know that comes from what we call the dividends tax account. And we have also said that when you talk about compensating tax, it's paid and filed by the 30th of the 4th month after the year end, after the year of the income. So this is what we call the dividends tax account. We have our first illustration. These questions are not been very common, so we'll pick a question that was done maybe a bit long. So we have our first question. Welcome to Manifestator e-learning platform. We continue with our series on tax planning, and we are on what we call tax risk management. So when you talk about tax risk management, we basically call it a good tax approach. We say good approach. A good approach is to have what we call a comprehensive tax policy. That a good approach is basically to have a comprehensive, that is a detailed tax policy, basically to provide clear guidance and detailed training on tax requirement, strengthen the policy with robust tax governance framework, and define your tax principle and stick to them. That's basically to manage the risk. Analyze your tax risk, considering both the risks that are known and unknown issues. Manage the taxes. So we say a good approach say a good approach. We basically say a good approach is to have what we call a comprehensive tax system. Is to have what we call a comprehensive tax system. Provide clear guidance. What we call clear guidance. Provide clear guidance and detailed training, and what we call detailed training on what we call, and provide what we call a detailed training on the tax requirement, on the tax requirements, detailed training on tax requirement, which is strengthen what we call the tax policy, strengthen the tax policy. We have strengthening the tax policy with what we call the robust tax governance program or framework, tax governance framework, with a robust tax governance framework. Define your tax principles. Define what you call the tax principles, the principles of taxation, and stick to them. And say stick to them. And basically stick to them. Analyze your tax risk. Analyze your tax risks, both known and what you call unknown. Both known and what you call unknown issues, both known and known issue, and manage, and lastly manage. We say manage the tax risks. Manage what you call the tax risks. And lastly manage what you call the taxes. In our quest to manage tax risk management, we've talked about a number of things. A good approach is to have, when you talk about a good tax approach, it's basically to have what you call a comprehensive tax system that is a detailed and again clear guidance and detailed training on tax requirements. We say strengthen the tax policy with robust tax governance framework. Define the tax principle, and after defining them, you need to stick with them. You analyze your tax risk, both what is known and unknown, and lastly, we talk about managing those risks. Welcome to Manifested e-learning platform. My name is Mr. Dongo, an advanced taxation lecturer. Welcome to our today's session. We are discussing on tax planning. Introduction of the tax planning. One is to define what you mean by tax planning. When you talk about tax planning, we are talking about what we call tax avoidance. So when you say tax planning is an arrangement of taxpayers' affairs in such a way that you are able to reduce the tax payable to the Kenya Revenue Authority without contravening the law. That you are arranging the affairs of the taxpayers in such a way that you are able to reduce the tax payable to the Kenya Revenue Authority without contravening the law. When you talk about contravening the law, we basically mean that without going against the law. What is the objective of what we call tax planning? One of the first objectives of tax planning is basically to have what we call tax compliance. Number 2 is to reduce cost relating to the non-compliance, is to reduce costs that are related to non-compliance, to ease what we call administration of tax, and finally is to achieve most advantageous position in the business. So we say tax planning. This refers, we say that this refers to the arrangement of the taxpayers' affairs, in such a way to reduce what we call the tax payable to the KRA, that is Kenya Revenue Authority, and you say without contravening the law. Arrangement of the taxpayers' affairs in such a way that you're able to reduce the tax payable, and the key concept is that you're not without contravening the law or going against the law. So we say that objectives of what we call tax planning. Objectives of tax planning. We have about 4 objectives. One is what we call tax compliance. To be a compliant taxpayer. That is number 1. Number 2, we talk about reduce costs. Reduce costs related. We say related to non-compliance. Reduce costs that are related to what we call non-compliance. And the third one is what we call administration of tax. Is what we call administration of tax. And lastly, we say to achieve the most advantageous, to ease the most advantageous tax position, the most advantageous tax position in business transactions, So this is basically the basics on what we call tax planning. So we go to tax planning for individuals. What we call tax planning for individuals. We need to understand that in relation to tax, we have 2 types of individuals. We have what we call the artificial person, and then we have the natural person. So when you talk about the individual is basically a natural person who basically have the APIN. And when you talk about the artificial person, that is a company, these are individuals that basically have the P, what we call the P pins. So what are the tax planning that are available to the taxpayers or individual? They usually taxpayers, we need to understand that taxpayers, we need to understand that the taxpayers basically have these areas of tax planning basically in employment. Usually taxpayers have areas of tax planning under what you call under the employment. Most of them, we know that they usually have these areas of planning under the employment. So tax opportunities that are available, tax opportunities that we know that are available, We have one, we can talk about when one takes a mortgage, what we call a mortgage, maybe mortgage to build a home. We say that mortgage is an allowable expense. When you talk about allowable expenses, these are expenses that can be deducted against a taxable income. If we can deduct them against a taxable income, we know that they reduce what we call the tax income, that income that is subjected to tax. So we say that those who are contributing to a mortgage, the interest on mortgage is allowable deduction to a set limit of a figure of 300,000 per annum, implying that per month the allowable expense for the mortgage is 25,000 per month. We also have what we call contribution to home ownership saving plan. That is what we call the HOSP. We say that HOSP, if one is contributing to home ownership saving plan, that is an allowable deduction to a set limit of a figure of 96,000 per annum, implying that per month allowable deduction is a figure of 8,000 per month. But we also have what we call contribution to pension. Contribution to pension, we have what we call contribution to pension. So when you talk about contribution to pension, and to be very precise, this should be what we call a registered pension scheme. A registered pension scheme is allowable to a set limit. Based on 2024, up to 2024, the figure was 20,000 per month and to 40,000 per annum. However, the changes to pension, which you know that pension, that is for those that will tackle examination that pertains to 2025, that will be 30,000 per month and a figure of 360 per annum. So you compare three things when it comes to pension. You compare the actual amount that has been contributed, you compare 30% of the gross employment income, and you compare with the set limit, and you pick the lower. When you look at these areas of allowable deduction, one of the most important things is to, whatever the taxman normally picks as allowable deduction is the lower. Even if you look at the mortgage interest, we look at the actual amount contributed, we compare with the set limit for the mortgage was 300,000, you pick the lower of the two. If you look at home ownership saving plan, again, we look at the actual contribution, we compare with the set limit, which is a figure of 96,000 per annum, we pick the lower of the two. One of the areas before we begin to put them down is what we call insurance premium. When you're contributing a premium towards a life cover or education cover. That is one of the areas, for example, when you talk about insurance companies, one of the areas that they would actually encourage taxpayers, especially individuals, to take these covers, education and the life cover, because the 15% of the cover per annum we compare with the set limit of a figure of 60,000 per annum. The lower of the two should be an allowable, should be what we call a tax credit. Not allowable deduction, but that area we call it tax credit because we less it directly from the gross tax payable. So we can start with one. We can start with the first one. We can start with the first one. And we talk about claiming honor, claiming of honor, claiming what you call honor, occupier, honor occupier, claiming what you call honor occupier, occupier interest, so what you call mortgage, so what you call mortgage interest, so what you call mortgage interest, so what you call mortgage. This is usually, we need to understand, this is usually a loan taken, that is usually a loan that is basically taken to acquire, or what you call to improve what you call residential house, to improve what you call residential house, to improve what you call a residential house. So say that the interest on loan is what you call allowable, The interest on loan is basically allowable. allowable expense is usually what you call allowable expense. Allowable expense is able to reduce the tax payable, and we say it up to a set limit of 300,000. So you compare what is the actual amount contributed with the set limit of 300,000. So the amount which can be used, the amount which can be used can be used to reduce the taxable income. The taxable income is the lower of the amount that can be used to reduce. The taxable income is basically the lower of what you call, you compare these two things, what you call interest paid. Then you have what you call the set limit, which is 25,000 per month, or what you call 300,000 per annum. So out of this, you pick the lower. So that is the first area where taxpayer can basically reduce. So the second, we talked about contribution to home ownership saving plan. That is what you call the HOSP. We say that HOSP, the amount that is allowed, the amount that basically is allowed to reduce the taxable income, we compare the actual contribution that is made to the HOSP and the set limit, which is 8,000 per month or 96,000 per annum. So say these are contribution. Number two, we